Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. Today's guest, Jacob Vanderslice, is a principal at VanWest Partners, a Denver-based real estate investment firm focusing on the acquisition and management of self-storage centers and other opportunistic real estate throughout the U.S. VanWest has established a track record with over $195 million in real estate assets. So I am personally looking forward to the episode. Welcome to the show, Jacob.
Thanks for having us on today. We appreciate it.
Absolutely. So we start with this question with every guest. Tell us something interesting or funny about yourself.
Well, I had sent you a few email responses in advance of the podcast. I'm not sure if I should use the one that I wrote down, but I guess I will. For whatever reason, I can shoot water out of my hands further and more accurately than anybody you've ever met.
Wow, that's interesting.
Where I picked that up, but I would compare it to like a Super Soaker 30.
That's interesting.
Yeah.
So how does that work? You just take water in your hand?
Yeah, just it's one of those, and I just know how to squeeze it out efficiently. Yeah.
Okay.
I get a lot of people wet who don't want to be wet when they're next to the pool.
So maybe you need to apply for a Guinness Book of World Records.
That's not a bad idea. I'll have to look up the record and see if I'm even close to it. And if I am, then maybe that's worth pursuing.
Yeah. So let's talk about real estate. What was your very first real estate investment experience?
My first real estate investment was in 2005. It was a long time ago. And I bought a single family home with a good buddy of mine in Denver. It was an up-down duplex. And we fixed it up on our days off, did the drywall, the tile, the electrical work all ourselves. Took forever. And then we found a couple tenants for it. We did no background checks on the tenants, no income verification of any kind. It was great. Here's a lease template, sign it, and move in. Yeah. And needless to say, those tenants didn't perform very well, but it was definitely a learning experience.
So, and how did that deal work out for you? Because I know you bought it at peak as
well. We hung on to it, and we actually sold it later and made some money. And had we known what was going to happen, we would have hung on to it much longer.
Right.
But, who knew how good things would get?
Oh, that's interesting. So you started with single family, and after that, what all did you do before you jumped onto?
Yeah, we did a lot of single family over many years, well over 1,000 buy, fix, and sell deals.
Oh, wow. So you were pretty much flipping.
Yeah, we did a lot of volume. It was mainly in Colorado, but all over the country. We did some stuff in the Central Valley, just east of you, 5 years ago, like 7 years ago. And then we got into commercial real estate in 2014. We started doing adaptive reuse retail projects, basically converting old buildings into multi-tenant experience-based retail, like restaurants, coffee shops.
That's interesting.
And then, we did some townhome development along the way. We've done some multifamily, land, office. We've covered a lot of bases. And we got into self-storage in 2015. And we had looked at the asset class for a while. And we thought we were, all the way back in 2015, we thought we were due for a correction, right?
I think since 2015, I have been thinking we are due for correction, but it's just not happening.
Yeah, just maybe it is now, but it certainly didn't happen, in the last 7 years. Yes. So we wanted to be more focused on an asset class that was more durable, scalable, repeatable, downside protected. So we did a few development projects here in Denver back then that we actually sold about 3 or 4 months ago. And then went into the Milwaukee market, and around 2016, we did some deals out there. And then we kind of kept going. And most of our deals were capitalized in single asset syndications with kind of programmatic LPs, investors. And then we launched our first storage fund in June of 19. We closed that in August of 20. We launched our second fund in 21. We closed that out at the end of 21. and we're on our third fund now.
That's awesome. So why switch from, means you have done pretty much everything, single family to adaptive retail as well as multifamilies. Why switch from all that into self-storage?
Well, we still have a number of our infill retail projects, and we still have a decent sized single family rental portfolio that we've owned for a long time. But the shift really is we just wanted to focus on cash flow, and we found that self storage was a great vehicle to produce cash flow. And of course, multifamily does, single family does too. Um, but in our opinion, the dividends you can realize from a storage portfolio are a little more substantial than you can a multifamily portfolio or a single family rental portfolio. So we wanted to focus more on one asset class versus being a little more agnostic and covering a bunch of strategies at once. And that's where we landed. And we didn't make a conscious decision to jump into self storage as a primary line of business. We just did a deal and did another one. And that's typically how shifts work, right?
Right.
It's never a big plan. Let's go try something else and see how it goes. And it went okay, and we kept going.
Yeah. No, and if it works, now you have the team, you have the right tools, why not,
Yep,
right?
certainly.
And the biggest benefit to me from self-storage perspective was no tenants, right?
Yep.
Means no termites, no toilets, no tenants. That was huge mind shift when I started looking at it. So I invested in self-storage in a fund as an LP. I would say 5 years ago. That's when I started learning, because I was already doing single family and multifamily. And then, of course, as I told you earlier, I invested in, or pretty much we bought our first self-storage with a mobile home park. But that was the biggest thing, that I don't need to manage anyone. I don't need to worry about getting a call, because most of the time, there is no tenant, right? Or not most of the time. There shouldn't be any tenant in
Right.
living in there. So one question I have though, so yeah, cash flow, I understand. The tenant side, is there depreciation like other, like large depreciation like multifamily or mobile home parks?
Yeah, and it varies from deal to deal, but you can do cost segregations. You have standard building depreciation, so you have a lot of the tax benefits in self storage that you do in any other real estate asset class. So it's definitely attractive from a tax perspective to hold these for a reasonable amount of time.
Got it. And I understand that we call mobile home parks senior housing and self-storage facilities that's more like recession-resistant assets. When you started looking at it, did you look at it? How did self-storage facilities perform during inflation or recession?
Yeah, inflation is a little more difficult to say because we haven't been obviously in an inflationary
That's true.
environment like this for
For a
decades.
while.
And self-storage certainly existed back then, but it was much more of an asset class kind of on the periphery of real estate
Right.
asset classes.
Yes.
It wasn't really widely accepted as a major real estate asset class. So we're not exactly sure how it did back then because there's not a lot of data. But in downturns, there's plenty of data, right? We had the financial crisis in
Yep.
2008 and the years
1000.
following, and of course we had COVID. And self-storage in the financial crisis hung in there. It was one of the better performing asset classes. It had one of the lowest default rates on the debt side. When everybody else was rolling over on debt, self-storage was performing better. And you kind of shift gears forward to COVID. Self-storage did spectacular during COVID,
Yes.
and it still is. And in fact, it kind of concerns us, like looking back. If you buy a deal today and you look at the last 2 years of financials, it
Yeah.
probably performed fairly well compared to how it performed the prior 2 years. But
Right.
how is that consumer demand going to shift? Are rates going to go down? It's tough to forecast, but it did very well during the financial crisis. Our metrics and a lot of other operators were all reporting record NOI growth from Q1 to Q1, revenue growth. I mean, there's been a lot of tailwinds for sure because
Yeah,
of COVID.
yeah. Last couple of years, pretty much all kind of real estate other than the office buildings.
Yeah.
They did really well.
Yeah, you've got office, hospitality, and to a degree retail
Yes,
that kind of got beat up.
yes,
Like our
got it.
retail tenants, of course, here in Denver, struggled during COVID,
Yes,
and they're still kind of clawing out of it. But one of the reasons we like self-storage is we're relying on thousands of people to pay us a tiny bit of money every month
yes,
versus, 3 or 4 tenants paying us 20 grand a month each. You
yes,
lose one of those guys and you've got probably a pretty big problem. But the chances that you have a substantial portion of your revenue in self-storage evaporate from one month to the next is pretty low. So that's one of the main reasons we like it.
no, I totally agree. And I have my own experience with one of my friend. He was renovating, and so he had to downsize. He was renovating his house, so he moved to an apartment. So he moved his stuff in a self-storage. He was supposed to keep it for a year. It became a couple of years. And then he's like, after he moved in the big house, this is like 3,000 some square feet house. And he's like, it's okay. I'm going to just leave it there. It's 60, 70 bucks a month. It's like coffee money. You don't even care, right? So, and when you upsize as well, people don't care because you have enough money. When you downsize, you really need to store stuff.
Yep. Yeah. That's many of our customers. They will move in thinking they'll be there for 3 to 6 months and they end up staying for 2 or 3 years. And we've had some customers, not during our ownership, but who have been in our facilities for 15 years in some cases, which is just
and the
incredible.
people who are storing their toys like boats and motorcycles and whatnot, they don't move.
Yeah, well, in a lot of cases, though, by the time you pay a year of rent, you probably could have bought new stuff, but it's out of sight, out of mind, and it just auto drafts from your credit card. If the price goes up a little bit, you're probably not going to go rent a moving truck and get your stuff out and put it somewhere else. So it's a very sticky customer base.
Yeah. This is our American mindset is we buy, and then we keep it. Like if I look at my garage, it's like full of junk. I don't want to get rid of.
Yeah, it's the American mindset. I might need that someday, or that's sentimental, or I don't want it in my house, but I want to get rid of it. That's really, those are good examples of demand drivers in the industry.
So let's talk about how you acquire. Do you buy existing properties or do you do ground up construction?
So we do both. Fund 3 is only buying existing storage facilities, and that can be any one of several deal types. We can buy a deal that's physically pretty full, but the rates are below market, and raise rates over time, control expenses. We could buy a deal that's empty, like a certificate of occupancy acquisition, lease it up and stabilize it. But Fund 3 is not doing any raw land development. It will do expansions, meaning we buy an existing deal, we've got excess land next to it, we build more storage. So our development program we're doing outside of Fund 3, mainly because it's just too much of a different strategy and risk profile. The upside's greater, of course, but the downside could be greater too, because you're not buying an existing building, you're putting up a new one. So we're doing those deals in single asset syndications outside of our fund. We just bought a site a couple of weeks ago on the Colorado Front Range. That's going to be all in at about 15 million. We have a couple others in Denver in the pipeline that are total project cost around 20 to 23 million. So those projects, it's a different animal because you're taking a year to build the facility, roughly.
Right.
Leading up to when you buy the land, you're spending 9 months getting your entitlements completed.
Right. That's huge.
That's a big process.
Entitlement is not done, then
yeah. And the entitlement process is much more difficult than it used to be. A lot of cities, for whatever reason, are more averse to self-storage than they used to be. So zoning has become tighter. It's just tougher to get projects approved. So you take a year to build it, and then you take 2 to 3 years to stabilize it. So you're not seeing cash flow from that asset for some time. So that's why we're doing that outside of our fund. They're good deals, but just a different kind of investor profile and risk profile.
Right. So let's talk about the location, right? Because real estate is all about location. How do you pick the right location for self-storage?
Well, the 3 risks in self-storage, we believe. One is rates. right? What are your stabilized rents going to be?
Right.
And if you get that wrong just a little bit, that's an exponential effect on the total value of the property.
Correct.
The second risk, which may seem like it's too in the weeds, but it's not, is accurately forecasting your property taxes. So if you accrue for a property tax figure and that property tax figure becomes 30% higher, that's a material impact on the deal's performance, especially in the Midwest where the property taxes are really high. So accurately forecasting and being very conservative on what your property taxes are going to be is really important. And the third thing we look at is the risk of new supply. And that's kind of subjective and objective to a degree. And the risk of new supply on a development deal, unforecasted new supply will affect a development project more so than it will an existing acquisition. Most of our existing acquisitions, if we're buying an existing facility, we'll buy those at a price that is substantially below replacement cost, especially in today's environment. Right. So if someone does build new product near us at some point, their cost basis is going to be higher, so their rents are going to have to be higher.
They have to.
We can keep our rates lower because our cost basis is lower. But in development, our cost basis is going to be similar to somebody else building nearby. So we really are careful about quantifying the risk of the introduction of new product. And we do that by pulling building permits, analyzing zoning, how many parcels in the 3-mile trade radius allow for self-storage use, how many of those are big enough to build a storage facility on. Have there been concept reviews scheduled with the city, which is basically a pre-flight, and many of those are public record. So if you bring a concept to the city and say, I want to build a storage facility on the site, it goes into their database and we'll catch that. So yeah, those are really all the risk factors, and those are kind of what drive our site selection. Above and beyond that, we look at supply ratios, square feet per capita. Some markets can support a higher square foot per capita figure than others because their rents are so low. So if you're in a 80 cent a foot market, a lot more customers are going to be able to afford to store. And even though the square foot per capita might be high, all the facilities are full because the rents are so low. And likewise, if you're in a market where rents are $2.50 a foot, that's expensive. You do the math on a 10 by 10 or a 10 by 20, that's a lot of money. So fewer customers in theory can afford to store there. So if more supply gets introduced, you're going to have a material impact on rates. So supply ratios is another thing. But then beyond that, just normal real estate fundamentals, real estate nuts and bolts, location. Is there a story for population growth? Is there job growth? Is there wage growth? We look at housing density. We look at incomes as a data point, but we care more about just rooftops in the submarket. If you're buying something in a overly rural location, even though it might be full and performing well, there's not that many customers out there. Not that many people live nearby. So you're not going to have as many people storing in theory. And if somebody builds a new product somewhere nearby, your supply ratios are going to be very thrown off because the population's already small. So a lot of data points we look at. Some are just more real estate focused, like location, story for growth, good demos, and others are more storage focused.
And do you also look at demographics as well as do you also want to have certain type of population, not type, but certain size of population?
Yeah, we target a minimum of 50,000 people in the 3 and 5 mile trade radius. Sometimes there's a story to buy in submarkets that have a lower population in the trade radius. Sometimes it'll make sense too, but we're not targeting deals in the middle of nowhere for all the reasons I just described. So we like to be in population centers. We're not, for the most part, we're not in many primary markets. Most of our markets are secondary and tertiary. And we found those markets to be a good blend of current yield and cash flow, but also with a capital appreciation component as well.
And do you like certain, let's say, stores or close to the self-storage, or maybe it's near to a hospital, or do you look at any of those criteria like landmark?
Yeah, we do. It's to a degree subjective, but it's always nice to see, national retailers nearby. They're probably smarter with real estate than many of us are.
Yes.
So if someone builds
Yeah, we look at Starbucks and Costco or
if
Walmart,
someone builds a
and those are
Costco or a
like,
Walmart or a Starbucks, there's probably a good reason for it. And if you're nearby there, it's probably a decent market. So we use that as kind of a data point. We don't really have a rule of thumb where we got to be within 3 miles of a Starbucks or a Walmart, but certainly something we consider.
got it. So can you tell us who all are part of your team while you're identifying the location, not just underwriting the deal and all, but the location?
Yeah. My partner Wade leads our acquisitions and operations team, and my partner John leads our development initiative. And I have another partner. There's 4 of us total. Aaron Westfall. We go back junior high, been partners since 2009 and everything. He's our CFO and IT guy, controller. He wears a lot of hats. But on the site identification side, we're okay going into new markets we haven't been before, as long as we believe we can get some scale there. We don't want to go to a new market and just buy one deal. So one good example is Oklahoma City and Tulsa. We've been looking at those markets for a couple of years. We were just down there this week. We have a portfolio under contract in Tulsa, and we have one deal under contract in Oklahoma City. So we want to get a couple more deals in OKC, but it's a good submarket. It's a good story. We were talking earlier before we started recording, the South has been good. Southeast has been good lately. So yeah, I don't want to say we're completely geographically agnostic. We'll go where there's a deal. There's some markets we don't love, like the Northeast. We're not really targeting much up there. If we see something that makes sense, we might pull the trigger. Not that there's anything wrong with the Northeast, but a lot of people are moving from there to Florida and Texas. So yeah, I would say in general, our portfolio is focused in the Midwest, the Southeast, and some stuff in the Southwest.
Yeah, I think that's where we focus, Midwest and Southeast as well. Yeah. And I was laughing when you mentioned Oklahoma City and Tulsa, because I have been there from my IT work. I used to go there 6-7 years ago, and I exactly know the locations. The OKC downtown is amazing now that they have redeveloped. And I have driven from OKC to Tulsa, so it's all oil.
I just did that drive this week.
Oh, you did?
Yep, I just did. Yeah, we were on the road at 7 a.m. and
you just don't want to drive on that road when it's heavy rain. I ended up doing that once, and lightning, and like I could not see I would say for 30 miles, I could barely see 3-4 feet ahead of me, and it was bad.
They get some serious convective weather down there.
Yes.
Yep.
Now we will talk about OKC and Tulsa at some point. So how did you build your team?
Our team has really been built organically over time. We've got about 75 employees now, and 15 of those are in our Denver office, and the balance are scattered around the country across our storage facilities, our on-site managers, regional managers. Our boots on the ground employees, we source in a couple different ways. We'll often hire the existing on-site managers from the prior ownership group. If they're a cultural fit and it makes sense, sometimes we'll hire new ones. But the folks in our Denver office have been anywhere from long-term relationships and referrals to being sourced from recruiters, people who have applied to job postings we've had on LinkedIn and Indeed. But we're very proud of our team. We've got some amazing people, very intelligent, hardworking, kind. Culture is a very important thing for us, and team building, especially in this environment, is not easy to do. It's tough to find talent. We're paying people a lot more than we used to, for all the reasons we know. But we're very proud of the crew that runs the shop.
Looks like we'll end up paying even more once this college loans are wiped out. A lot of them wouldn't even want to work again.
Why get a job now that my debt's paid off? Yeah,
exactly. Yeah, well, you and I will pay for it, but yeah, at least they don't have to pay.
We certainly will, and we already do.
So let's talk about the deals, right? So do you have a self-storage deal which was like home run, which was the best self-storage deal? Can you share some numbers?
Yeah, we sold our portfolio that we had built starting in 2015 to Extra Space at a 2.8 cap, which is pretty irrational. I'm not sure what they were thinking, but that was fine. We had some deals in that portfolio that were real skinny, but other deals did 30% IRRs. So in aggregate, it was profitable and it worked. Beyond that, we're not trying to sell anything. We don't want to sell anything anytime soon. We want to build this asset base, continue to build this asset base, and focus on just recurring revenue streams and cash flow. Eventually, we're going to monetize it at some point. But one of the main mistakes we've made in our careers is just buying, making better, and selling too often and too quickly. And we shifted that focus, call it starting 4 years ago, to more building a business around recurring revenue streams versus transactional revenue streams. So yeah, that portfolio did well. But the home runs really have been deals that we haven't round tripped, deals that we've just seen explosive NOI growth on. I mean, there's some deals that we bought 2019 where our NOI has tripled since then. And that's a combination of occupancy growth, rate increases, controlling expenses. But those have been the home runs. And when you see that kind of NOI growth, it's tempting to sell.
Right.
But there's always a price, right, that would make sense. If somebody showed up and said, I'll pay you something crazy, we consider it. But we love the cash flow. So our biggest home runs have been the deals that produce what we think are above market recurring revenue streams.
So let me ask you this, because most of the deals I do, or most of the deals the operators have, they look at exiting in 5 years or maybe 7 years. Do you guys have any exit plans on those deals?
So we underwrite, in Fund 3, we underwrite a 7-year hold on every deal that we buy. In our development line of business, we underwrite a 5-year hold. But an exit is not necessarily a sale. There are a variety of ways that the equity invested in the deals could substantially be returned before a sale. One way is excess net income.
Yeah.
And another way is a refinance. Yeah, exactly. So if we create a scenario, which we did on Fund 1, we refinanced about half of our investor equity back out in January, and we got 10-year fixed debt at a 4 interest only.
Nice.
We're going to hold on to those for a while and just enjoy a very above market dividend yield. So we underwrite a 7-year hold, but we, as you know, we can't control cap rates. We can't forecast where cap rates are going to be in 7 years. We can't control interest rates either. And we can't forecast where rates are going to be in 7 years either. I mean, we have an idea, right? We just got word the Fed's going to do another aggressive rate hike. Everyone's saying that it might moderate by the end of next year and start to kind of come back to sort of closer to where it was. But we can't control rates and we can't control cap rates. But to a large degree, we can control NOI. We can work to grow NOI. If there's a problem on a deal, we have a cash flow problem or a revenue problem, there's probably something we can do to fix it, right? We can control expenses tighter. We can spend more on advertising. We can put some improvements into the building. So we really just focus on the things we can control. And I think if you're growing NOI and growing cash flow over time, to a degree, everything else kind of takes care of itself.
Right. And are your investors okay with not selling?
Well, we're going to sell at some point. We're underwriting a sale of 7 years. But if there's a scenario where we can do a substantial return of capital or all their capital, I think most of them would be pleased. Hey, all my money's back. I'm still getting depreciation. I'm still getting distributions. And I still have the same number of shares in the fund I had before. Why get rid of this income stream and why pay taxes when I don't necessarily have to? So I think our underwritten timing on the sale of these is 7 years on an individual deal by deal basis. But I think when we monetize our portfolio, it's going to come in the form of either a massive portfolio sale at hopefully a valuation that's greater than the sum of the parts, or it could be a recap, bringing in a new source of equity at a stepped up valuation, giving everybody an option to either have a liquidity event or roll into new co. But our modeling that drives our return targets assumes a 7-year hold.
Got it.
Yep.
So let's talk about the worst deal, if you had any.
The worst deals I could remember those like they're yesterday. You never forget the bad ones. The home runs, you kind of like,
Right.
I feel like you kind of have to think about for a minute, because sometimes the home runs are, I don't want to say luck, but sometimes they're timing, right? You've
Yes.
executed well and you
Yes.
mitigated the downside, but you had some tailwinds and you just knocked it out of the park and you didn't expect it. And you certainly didn't model it. But the failures, you remember, constantly. So we have one deal that we still own. Thankfully, there's no investors in it. My two partners and I bought this deal in Iowa as part of a 1031 exchange.
Uh-oh.
And we had a big tax bill if we didn't place it. And this thing was pretty busted, but we identified it, so we pulled the trigger and we closed. And it just hasn't performed very well. And there's a lot of reasons for that. But it's just a good example of how, if someone's in a 1031, you really got to think to yourself, would I buy this deal otherwise if I was not in a 1031?
Right.
And if the answer is no, you got some self-reflection to do.
Now that is so important, because 1031, you are always rushing. You have time crunch, and you don't realize that you may not even look at this deal if it was not for 1031. I agree.
Yeah, especially especially these days, a 45-day identification period is really tough to find something that makes sense.
Yep.
Yeah.
So this was great. Thank you so much, Jacob. Let's move on to fire round.
All right.
Would you be changing any business or investment strategy because of inflation or recession?
Not really. We're cautious and conservative in our assumptions that we make when we buy deals, and we were like that before COVID, and we're like that after. The big thing in our underwriting, and really anyone's underwriting, you got to ask yourself, are the assumptions I'm making in my model, are they reasonable and achievable? Right.
Yeah.
What you shouldn't be saying is, if everything goes perfectly, this deal is going to do a 15% IRR, right?
Right.
So we really make sure, at least what we believe to be, we implement reasonable and achievable assumptions. As far as how we're reacting to this environment, we don't want a downturn more than, we don't want a downturn, right? Careful what you wish for. But historically, self-storage has been defensible during downturns. So if things get worse, which they probably will, self-storage historically has performed fairly well. It's hung in there because when there's a dislocation or disruption event, people need self-storage. As far as inflation goes, inflation to a degree is a good thing for self-storage, at least on the ownership side. And the reason for that is all the leases are month to month. So if you have a highly occupied unit type, say you're 98% on 10 by 10s, you can raise rates on your customer base and on new customers and probably not get a lot of move outs. The big question is, as we increase rates and mark more customers to market, how much more of a monthly nut burden can American consumers sustain when their rent's going up, their gas is going up, their insurance, their utility bills? So at some point, there's going to be a break on what people can kind of handle. So self-storage on the revenue side does benefit from an inflationary environment, but you're also catching higher costs on the expense side. Our operating expenses last quarter, for example, in our second fund, they were about 9% over forecast, which is not huge. And but the reason for that is a lot of our service contracts have gone up. Our vendors, our landscaping companies, our repair and maintenance guys, our employee payroll, it's all increasing. But thankfully, the revenue side has been increasing a lot faster than the operating expense side. So we'll see what time shows us in this continued environment that we're in. But inflation is self-storage benefits to a degree from inflation.
Well, that's great. Any favorite real estate or business book?
I mentioned this in my email to you. I don't do well with business books. I've read all the main ones. Good to Great, Rich Dad, Poor Dad, but my main my main reading genre is historic nonfiction.
Yeah, okay.
I like reading books about leadership and, encountering adversity. A big World War II buff. Read a lot of World War II books. Really, just kind of anything that's historic nonfiction with a leadership component. I'm reading a book right now called Spearhead about a World War II tank crew. Another good one that I mentioned on way too many podcasts, but it's called In the Kingdom of Ice by Hampton Sides. It's a book about early polar exploration and what those guys went through. If you and I have a hard day at the office, it doesn't even compare to what they went through. Right. Yeah.
Yeah, no, I just, you just reminded me, I was just in Ohio when I visited Pearl Harbor and learned a lot about World War I and II.
Yep.
So it was very interesting and eye-opening.
Yeah, that was a pivotal time in our history for sure.
Any tool or website you recommend?
Yeah, we use Slack for our intercompany communications. It's a great tool that kind of reduces your email traffic. We have different channels like property management, acquisition, capital development, ground up development. So Slack has been a good tool for us. The only thing I don't like about it is it's if it's after hours and someone's writing a bunch of Slack messages, it gets a little notification heavy. A lot of vibrating phones versus email doesn't do that. But Slack's a good tool. Another one we use is a platform called Basecamp. Basecamp is where we track all our development deals, and you can make a new project inside this platform, and you can really see the history of all the underwriting, the different models. Like you can look at especially on development deals, you'll go under contract on a project and you won't close it for 9 months. So you'll make a model with your assumptions 9 months ago. And as you get your hard costs in and your final term sheet from the bank, those assumptions change a lot. So it's fascinating to see like a time-stamped kind of evolution of those modeling assumptions. So yeah, Basecamp and Slack are two that we definitely recommend.
That's great. Any advice for beginner investors?
Yeah, I mean, I love talking to folks thinking about getting into real estate, but fundamentally, I think my main advice is take a risk. Let's say you're a high earning W-2 employee working for a big company, and you've always wanted to start investing in real estate, you've read books about it, you've gone to classes, and you just haven't done a deal yet, go out and do a deal, whatever that might mean. Buy a single family rental, buy a duplex, invest in a third-party syndication or fund. But the best way to learn is to take action and take risks. There's no perfect deal. There's nothing that's completely downside protected. So there's always going to be risk in everything you invest in, but you're not going to learn how to invest until you start.
Right. And this is what I tell almost everyone on my podcast, and most of the guests have mentioned, right? You can listen to as many podcasts, go to the meetups, watch YouTube, but if you don't take action, you are not going to learn.
Yeah. It's and I've had an expensive education from just mistakes I've made many times over 15 years of investing in real estate. And I like to say that we're not smart. We just get less stupid every year.
Yes.
We don't know what to do, but we certainly know what not to do. Yeah.
I agree. How do you give back?
A couple different ways. I used to be involved with Big Brothers Big Sisters. I had my little for 9 years. Then he grew up, and I recently joined a local hospital board called Craig Hospital here just south of Denver. And they're a neuro rehabilitation facility, and they exclusively focus on traumatic brain injuries and spinal cord injuries. So if you get in a really bad car accident and you get a head injury or you get a spinal cord injury, you go to the ER, right? They get you stabilized. And once you're kind of stabilized and you're not declining any further, you go to a place like Craig to learn how to live again. You wander the halls of Craig. People are learning to walk. They're learning how to get into a mocked up airplane seat. They're learning how to use the bathroom in a different way. They have a pool. What they do there is just absolutely amazing. So it's a special place.
That's awesome. How can my listeners reach out to you?
Yeah, a couple different ways. I'm always happy to talk shop about real estate, as you might have inferred from our conversation. You can email me, jacob@vanwestpartners.com. Hit me on LinkedIn, Jacob Vanderslice, or go to our website, vanwestpartners.com.
Thank you so much, Jacob, for your time. I had a lot of fun.
I had a blast. Great to meet you. Thanks for having us on.
Absolutely.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!